May I now ask the Value Invest professionals to prepare for the Q&A? Okay, Ryan, unmute yourself. Ryan Kim.
Hello.
Hello. Okay, hi Ryan. Who are you asking questions?
Yes, this is for Mohnish. By the way, thank you very much for the conference and great presentations. Yeah, so hello from Paris. And my question for Mohnish is that, sorry, actually, let me take off the mask real quick. Okay. Yeah, he talked about changing the lens or the singular focus through which look for investment opportunities, So he went from $1, finding $1 for 50 cents or 30 cents to finding 100 beggars. Does he think, or do you think it'll be hard or impossible to change the lenses often? For example, for 6 months, I look for, $1 for 30 cents. And for next 6 months, I look for 100 beggars or 10 beggars or 5 beggars. Do you think it's inefficient or not really a good way to approach this?
Yeah, that's a good question. And no, I don't think it's a good way to approach it. I think 6 months is too short a period to find anything. If I am able to find one 10-bagger a year, forget 100-bagger, I think the gods are being very generous to me. So I at least for me, I've always found that what works well is to be singularly focused over very long periods of time. Kind of like Costco, just same model, just keep cranking and keep improving. And so I want to stay focused on compounders. And the other thing about this, the journey 10 baggers, 100 baggers is there is so much tax efficiency when you go down that path. It's beautiful. And the other thing is that what has happened, what has already started happening at Pabrai funds is that I have some positions which are where we own, let's say, 10% or 9% of the company. We've owned it for several years. And now we've been invited into the tent. So I'm not interested in activism. I'm interested in a love-based approach. And so these founders and CEOs, reach out and ask what we think and what we should do. In the case of one company, they want a lot of input from me. So that happens once there's trust. And so that's the other thing that's kind of interesting here. Of course, I'm a little bit wary because, Buffett says if they need my help, we're both in trouble. So I'm not looking for extracurricular projects. But yeah, I think it's great to just stay very focused. And at least for me, I'm just going to stay on this treadmill for a while.
Thank you.
Thank you. Let's go to Douglas. Douglas Stoddard. Unmute yourself.
Hi, everybody.
Douglas?
First, thanks for all your great, hi. Thanks for all your great presentations. Love hearing the different perspectives. Dianne, this question is for you. Loved the passion in your presentation, and it's very clear you're a big proponent of ESG and its values. The social aspect of ESG is quite controversial now, isn't it? With NASDAQ pushing different board diversity quotas, et cetera, et cetera. I wonder what your thoughts were on quotas versus merit-based selection of individuals for whatever we're talking about.
Yeah, I mean, from our standpoint, we're activists. We certainly, like to work constructively with companies. A big part of the work that we do is to certainly consider boards because sometimes we're lucky and we get involved in companies where, the valuation is very much dislocated from what we think a company might be worth. And there's not necessarily any kind of dysfunction associated with that. But in many cases, there could be something, the company has experienced a setback. And so we're really digging in to understand, even in companies that are well run, can the board be improved? And, we do that through a prism of what looks like a matrix, understanding the composition of the board, understanding the business, that the company is involved with, and understanding that companies and boards should in many ways reflect, companies are not built with one skill set or one resume. And that's something that we often find. We find boards that, clearly I sometimes am known for calling out one particular board for being stale, pale, and male. But, lack of diversity extends beyond, those considerations. We regularly find boards that have the same resume. Everyone's been a CEO. And, unfortunately, if that were kind of a fail-safe for, ensuring a company's performance, maybe we wouldn't have a job as an activist, because we come across that a lot. So, there's clearly a very robust conversation happening. And there are absolutely, countries in Europe, for instance, that have quotas. You have states like California that have taken action to, set diversity quotas. And then you have steps like the one currently in process at NASDAQ. Those organizations or those, countries or states, they're making that determination. I would say in the case of NASDAQ, they likely understand that diversity is a benefit. It can be something that protects against groupthink, which can be a fatal problem for companies. And that's how they're arriving at that. We do consider diversity to be important, but we don't necessarily need to engage in any kind of value judgment around, other mechanisms of change that may be propelling diversity, at something like the NASDAQ, because we're just focused on the companies that we choose to invest in. And we're working to understand, what are their needs at the boards? What are the shortcomings? What are the opportunities for improvement? And very often, particularly within small cap companies, which is, again, where we're focused, diversity in kind of the most common usage, be that gender diversity or, racial or ethnic or multicultural diversity, it is very often lacking. And that's a problem. And something that is consistent for us, is that as activists, it's been our whole experience that problems don't exist in isolation. When we have boards that are, entirely composed of a singular type of resume or attribute, we do not find a situation where that board is similarly getting, or I would say dissimilarly, getting everything right on the operational front. It is often an indicator. When you see one problem, my grandparents, they were born in Ireland, they were farmers. My grandfather used to say, there's never just one mouse. Meaning that you don't find a mouse, you find mice. There are many problems. And so, these things, they exist together. And that's really what we're there to, help the companies overcome.
Mano, I'm muting you. So, Mano?
Thank you. I was a student in 2016. Professor, it's good to see you again. And thank you, panelists, for your time. My question is also to Dianne McKeever. You're talking about ESG and the examples of BP, the example of wind resorts and Boeing. And in all of these cases, these things that happened where things that an arm's length investor could not have known ahead of time. We don't have any insight into what the behavior of individuals is, what the culture is in terms of safety. And, instead of BP, it could have been one of their competitors that was operating the rig next door that could just have had a bad day and a series of bad decisions. So I agree, this is a huge threat to investments, but how can we as value investors protect ourselves from these ESG risks that can only be obvious in retrospect? Thank you.
Thank you for the question. This is an excellent question. I guess I would start my answer there with, highlighting, that we, and like most people here, we're public company investors. And public company investing comes with many attributes. We have, access to a breadth of investment opportunities at any point in time. We have liquidity, but we are not private company investors. Private company investors certainly have a lot more access to data and to practices and to information about companies. And that's a concession. There are upsides to that concession, but as public company investors, we are out of the gate conceding that we don't have all the information. And, so I am here and talking about ESG, and part of that is to really kind of normalize the conversation around ESG within the context of risk factors and opportunities that you're already thinking about at companies. So you're right. You as a public company investor, you can do as much work as possible, like we do. We do deep dives. We understand, to the greatest degree possible through our conversations with the company, through our diligence of the competitive landscape, through kind of a whole host of different exercises, as much as we possibly can. But a risk factor like, an absence of maybe needed safety protocols at BP is not necessarily dissimilar from, understanding, a company that has a product, whether or not the R&D that's in place continues to be strong enough to, prevent a risk of, say, product obsolescence. We can do as much work as we possibly can around that, but we are not private owners. We are public company investors with access to a set of disclosures and, an ability during certain times to be able to call up management or call up the board and have those conversations with them. And so I think, in part of my being here is, again, to ESG is in for many people something new, but it really needs to be considered in the same context and through the same prism of any other type of risk factor and opportunity. And I would say that we are activists. So, clearly we could get a little bit involved in terms of maybe remedying some of these shortcomings. But towards the end of my speech, I talked a lot about investment stewardship. And I think that, this is something like it is new for many investors that I speak with, like, today, I think that that's a great example. On the other side of the equation, the companies that you're investing in, especially if they're smaller cap companies, these could be new issues that they're thinking about as well. That doesn't mean that they're immaterial or financially immaterial risks or opportunities, but it could be that they're in a newer place in thinking about them. And so this, goes precisely to the point of, engagement is a big part of, being a great steward of capital and effectively shining a light for these companies on things that you are thinking about. And, at the other end of the telephone or on the other side of the table is a human being. And as an investor, when I call and I ask, a CFO, for instance, hey, could you give me more detail about this balance sheet item? That might be something where my question prompts that individual to think about that in a different way. What does this asset represent? They could think about it in a different way. Similarly, when you bring up, what are your safety protocols? That might prompt a response that makes that a safer investment for you to own. And then I would overarchingly say that, disclosure, there's nothing in companies that's a fail-safe. But disclosure and transparency, they matter. I think about the Peter Drucker quote a lot. What gets managed, what gets measured gets managed. Companies that are thinking about these things, that are transparently disclosing them and therefore holding their feet to the fire. Again, there are no fail-safes, just as there is not a fail-safe for, an internal R&D effort and that it's strong enough on a forward-looking basis to maintain a moat. But transparency and disclosure can certainly be, helpful for investors who maybe, especially if they're not activists, to help mitigate some of the risks that ESG factors could expose them to.
Thank you. Shiman, over to you. If you have any questions, especially for the other panelists as well.
So right now we have like a few upvoted questions, and they're sort of for Dianne. And I see that Patrick has his hand up, and he had a couple of questions that were also upvoted. So I'm wondering if he wants to ask them out loud.
I'll unmute. Okay, allowed to unmute. Okay, unmute.
I did have a couple of questions for Dianne, but actually the question I raised my hand for was for Francisco. So Francisco, Buffett likes to say that when he thinks about a company's moat, he likes to think about, would he like to have $1 billion and compete against that company? In the case of Dixon's, what gives them their moat?
I think that the moat is the combination of both the physical stores and the online presence. And it's a good comment from Buffett, but I mean, boats come in very different shapes and colors. And in this case, okay, can you set up, 1,000 stores in the UK, in the Nordics, anywhere, and then set up your website and up and running and all that? How long would it take to do that? I think that's almost impossible. But even for someone like Amazon, it's not worthwhile because the market is too small for them. And so they have a good presence online, but they have never spoken about having physical stores in the real world. I mean, so, and believe me, I guess they have more than 1 billion at their disposal. So I think for practical purposes, the market is not big enough. It probably is not one of these big markets in which you can make something like 10 times your money. But it's a market big enough for them to make money, but not big enough for have one of these very strong competitors spending $1-2 billion and making inroads. As you have seen, the last competitors that came into being were competitors like AO World, of previously Amazon. AO World in the UK still is not making really much money, and as you have seen in the last 6 months, Dixon's has grown much faster and much better than them. So I think it's a combination of things that make it almost impossible for anyone to come and make significant inroads in the segments. And as Bruce Greenwald said, and other people say, I mean, the market shares have been quite stable. No entrants, the leaders getting more and more share every year. So it looks like quite significant barriers to entry.
Good. Samantha, ask one of your questions.
Sure. So Shubham has a question around crypto investments, and he says that how would the crypto investments fit in the value investing landscape, and how can we determine the true value of such investments?
This is to anyone or any particular person?
Yeah, this was to the whole panel in general.
To the panel. Okay. Somebody wants to take this question? So, is it gold? As good as gold? Cryptocurrencies? I don't know, James Grant was talking about being invested in gold. How about cryptocurrencies? Bitcoin? What do you think, guys?
Well, my personal, I will answer. I think they are similar to gold in the nature. I mean, the value is the trust that people have in them, because the service that the product provides is I would say is limited, as in gold, to some extent. So there is no much industrial or commercial implication in the selling of the products. So, I mean, if you like gold, you may like perfectly well Bitcoin. I mean, gold has a longer history, so much more. You may have a more reference point as to what is the right price, but in the end, the right price is the trust people have in gold or commodities vis-a-vis fiat currency. So, which is how can you value trust? Or I can't, so it's difficult for me to invest in these kind of things.
Yeah, I mean, that was the question, I guess. As a value investor, would you invest in these things? Or in assets that have no intrinsic value?
I explained that before, and I explained it more extensively in the book. I mean, we invest in real assets. And on one extreme, you have gold and perhaps Bitcoins with not real industrial commercial value, but, there's a trust value there. And in the extreme case, these are the amazing companies with a huge moat, impossible to replicate. And you can invest in the whole chain. So you have to decide where to go. I mean, I would never invest in the right side, close of Bitcoins, because I don't have the way to evaluate both Bitcoins or cryptocurrencies in general or gold. I may have some ideas how to evaluate some commodities, oil, copper, things like that, and then I may have some ideas on how to value moats in some companies, and I will go for that. But I think it's a personal question. It's like Mohnish said. I mean, I try to go for for companies that may maybe invest in there for 15 years, 20 years, 100 times return. Well, and there are so many approaches to value investing that everyone can. All of them are right, are correct, but it's not for us.
Another question, Simon?
Yeah, so this one's for Guy. In a declining business, you need to be very confident that the free cash flow is returned to the shareholders and not spent on acquisitions. If management would start looking for a new destiny for the business, but how else will shareholders get an attractive return on their purchase price? It is unlikely to come from multiple expansion.
So I'm assuming this is pertaining to TVA, TerraVest, not a declining business,
right.
Growing substantially. In fact, interestingly about TerraVest, even the parts of the business that some people will say, oh, for example, propane tanks. Oh, that's declining. But even that's growing because, believe it or not, people use propane for heat. The homes that use it for heat rarely replace it with something else. And in fact, growing ESG activism means people don't even want natural gas connections to be extended. And so the homes that are relying on propane have stayed that way. And when you have a strong consolidated market, you get some pricing power as well on top of that. You wouldn't believe how much money they make, for example, on their heating oil tanks business. So it's not even a decline. Even their lowest growth businesses are not necessarily declining, maybe will be in the very long term. And the business itself is certainly not, because they've managed to redeploy those cash flows. Think about a business that just started off making heating oil tanks, which you could have said, oh, that's declining. How are you ever going to grow? How are you ever going to get multiple expansion? And then use that for first propane tanks, then propane trucks, large propane vessels. You have propane bullets that can weigh 200,000 pounds, refurbished tanks. Then you start getting into all kinds of other industries. Now, it could be LNG, CNG, even hydrogen or renewable natural gas or things of that nature. So definitely not applicable. For TVA, well, I guess that's the magic of it. It's so cheap that the merely piling up of cash on the balance sheet, if they do nothing, is going to produce fantastic returns. 2-3 years of free cash flow, and now your cash equals your market cap. And you still have a business that's making a lot of money. The other thing I try to convey is that I'm conservative, but
yes, I think we lost Guy.
Off by taking, again, their solid broadcasting cash flow and then using that to get into film production and distribution. So they bought a company that has does film studios and audio visual, all that kind of stuff. They have actually managed to keep their cash flow stable and even growing if you look at the past 3 to 5 years. I'm just trying to say, we're value investors. I'm looking at the margin of safety. You have a margin of safety. It trades at 2 times trailing free cash flow, maybe 3 times, let's say, conservatively adjusted forward free cash flow. But they've actually managed to grow. I'm not saying that they necessarily will. I don't want to bank on that, but you don't need to. And even if they only keep things stable with that sort of preposterously high initial return on your purchase price, I think you're bound to do well. And that was the point I was trying to convey. TVA, usually we look more for the likes of TerraVest, where you're getting an attractive free cash flow yield, in other words, an attractive upfront return on your investment, and an attractive growth rate on top of that. We want that complete package. And I echo much of what Mohnish said. Look, TerraVest, what gave us our confidence? Very entrepreneurial management with lots of skin in the game. We've been involved in this stock since it was $2. It's paid since then probably 4 times, 5 times that much just in dividends, and gone from 2 to 17. And it's still that cheap today because of their ability to grow and compound, redeploy capital effectively. TVA would be more than the exception, but I just could not resist bringing up that exception, such an obvious and blatant exception to this value investing crowd. But again, I think the crux of it is that you don't really need growth. Of course, you don't want management. The one risk is that management blows up. Let's say it levers up 5 times EBITDA to buy an awful business that immediately goes into decline. Those scenarios could always happen. But then you have to ask, what is the evidence that that could actually happen? And they've never made such a large acquisition. They've certainly never blown up like that. So there's no evidence to suggest that it will.
Thank you. Let me ask one more question from the raised hands. Subramaniam, allow you. Okay, you can unmute yourself. Okay.
Yeah, can you hear me?
Yeah.
Okay, thank you. So I guess my question is, when it comes to talking about compounders, whether we're talking about Amazon or many other, companies that were mentioned along the lines of what Nick refers in his letters as well. Such companies with strong durable moats, right, seem to have sometimes negative or modest free cash flows for many years before the flywheel effect takes up. Now, in the case of Amazon, Bezos was, someone who was a major shareholder who could take up that heat of sitting through negative flows and then eventually turning it positive. So the key question is, is it possible for value investors to, quantitatively pick such winners ahead of time? Because it's almost entrepreneurial. And while we can see it in hindsight, seeing it in foresight seems to be much more qualitative than quantitative. So are there any thoughts from, Mohnish and even from, Francisco, whose book, heavily inspired me, because productivity cannot be 100% from intangibles is one thing which I've learned from the, from the Austrian School of Economics as well. So any additional light in terms of quantitative versus qualitative in how we view these compounders would be very, beneficial for my learning. Thanks.
Okay, so
I can go first, if that's okay.
Yeah, and then.
Yeah, so that's a good question. So I think if you study the Nick Sleep letters and you look at Amazon, for example, I think that a lot of the return they got on Amazon was not in sync with the analysis they did. So their original understanding of the business was it was an incredible player in e-commerce, and it had a certain percentage of the e-commerce pie, and then they extrapolated what part of retail could go digital, and then what part of that digital portion could be Amazon. So in none of that analysis was there any discussions on the cloud and so on. And of course, the letters end in 2013, so a lot of what Amazon themselves came up with. What Nick did recently is, and I think in the last year or two, is when Amazon hit about $1,500 a share, he cut his position in half, and I guess he got goosey. So it was, he's running his own money. It's become such a large portion of his net worth. And he actually mentioned, this is in William's book, he mentions that he really struggled. He really struggled with that decision because he believes so strongly in the Walmart model where you just hold this great business. But I think he was questioning valuation and so on. And of course, Amazon has more than doubled since then. He's not suffering because he put it into another business, ASOS, which has done quite well. But his partner, Case, so it's interesting, the two guys, they joined at the hip, then they separate. Zach, when he got his money, he put it into 6 stocks. So he didn't go 3 like Nick. He went with 6 stocks, which are also in the portfolio, and he never touched Amazon. And actually, so Zach's position now in Amazon is bigger than Nick's position was. And then if you look at someone like Bill Miller, who's, I think, been an Amazon investor for more than 2 decades, I think Bill's personal holdings in Amazon would exceed both these guys. Very significant. So, I mean, I think, something like Amazon, it's outside my pay grade. I couldn't figure it out. But this is the good thing about investing, is that we can have a very good life and we could have a very good career without understanding 99% of how the world functions. So you can miss Amazon and you can miss, hundreds like that, and it doesn't matter. There are no call strikes, and there's lots and lots of ways to get to Mecca.
Thank you, Mohnish. Simand, let's go one more question because you're running out of time slowly.
Yeah, so this one's for Evan. It's a quick one. So how can an individual investor find out the net promoter score?
Yeah, it's a good question. I wish it were easier. So far, it seems to be sort of scattershot. So in certain cases, there might be industry reports, like I mentioned in the UK. The UK travel industry puts out, there's all kinds of publications and that kind of thing. If anyone knows about any kind of central database, I'd love to hear about it. But of course, there's also a lot of industries that don't have it. And so someone would need to replicate that or pay for a study to have it. But it's becoming more and more popular. So I expect that, it'll be easier and easier to find over time.
Yes, thank you. Last question. Let's see. Gregory Kojic had his hand up for some time now. Okay, Gregory, unmute yourself and please ask a question. To whom?
Great, thanks. Can you hear me?
Yeah.
Portfolio concentration question and how inherent that is to the whole idea of value investing. And I'm just going back to what Mohnish was saying about, making compelling point about holding on to a stock, even though it becomes a very significant portion of the portfolio, whatever that portfolio is. So I'm just wondering, is there somebody else on the panel who would take a slightly different view, that maybe like basically where do you cut off your holdings? How much can you hold on to something, particularly if your clients are pension funds or endowment funds, for example?
Okay, we have 2 more minutes. So anybody wants to take a quick stab at this?
Yeah, I can take a stab at it. There, like many things, there are no easy answers. It's like the question to Mohnish: how can you quantitatively identify Amazon? There's no easy answer. You can't. You need some kind of qualitative insight to reach those conclusions. You won't get it for 100, 1,000 companies, 99% of the companies. Some you will. But it's never that easy, and it's the same here. There's no really easy answer. It depends on the person's style. It also depends on how you structure yourself. So, for example, if you have large institutions, pension funds, people who want monthly letters and are scrutinizing your portfolio all the time, and et cetera, then you'd have to size it smaller. If you have very patient, long-term people who you've done well for over time, and who are long-term value investors themselves, who understand and are in sync with your philosophy, then you can go much bigger. So, for instance, for us, we've seen a company like I mentioned, for example, TerraVest, been a multi-bagger many times over. It's become a giant position. We've barely sold. We trimmed a tiny bit because it got to, such a high proportion, I don't even want to say. It was just absolutely enormous. But the partners always understood, because the rationale always makes sense. They get the philosophy. They're there because they like the philosophy. They're not just there because maybe they're chasing some return. They've gone through Rational, my fund, in depth. They're comfortable with it. And so we've been able to do it and keep it a very, very large position. Because there's harmony between us and our investors. So I guess in a roundabout way, I would say, understand yourself. There's no one way. There are many ways to get to heaven. You could also do well being a diversified investor, but understand yourself and structure your investment life to be consistent with you, with your strengths, with your nature, with your tendencies. You may have to make some compromises in order to do that. but it'll be well worth it because you'll be able to invest the way you want and live the life and structure your day and your routine the way you want, and you'll be happier for it, and you'll still do fabulously well.
Your time is up. I'd like to thank you all in the Value Investing panel for your wonderful, diverse, and informative presentations and for taking time to answer the questions. Thank you.